Hi everybody, this is Michael Minson with the Level Up Group at Keller Williams Luxury International. If you see a bunch of people running around like their hair is on fire, stay tuned for a market update reality check that should douse some cold water on those flames. Stay tuned after the break. Hi folks, if you've been anywhere near a TV or the internet for the past few months, you'd think it was time to sell everything and run for the hills. I'd like to hopefully assuage some of those concerns and share the reality of what we're seeing in the real estate trenches around pricing, interest rates, and the stock market. So our team covers San Francisco, the East Bay, the Peninsula, Marin, and even wine country. So we have a pretty good visibility to nearly all of the Bay Area real estate markets. Now, before we jump into housing prices, it helps to understand how macro factors affect real estate. Now, the biggest leading indicator for real estate trends is incomes. If you don't have a job, you aren't going to be able to get a loan. Let's look at unemployment rates to start. San Francisco is nearly at pre-pandemic unemployment numbers, which is just a half point over the record low unemployment rates we saw in 2019. We had reached a 2% unemployment rate before the virus came to town and turned everything upside down. Now we're cruising in at a very respectable 2.5%. The other big change that we've seen is rising interest rates. The good old days of sitting at home all day and refinancing into a 2% loan, well, those are well behind us. And now that many folks are heading back to work in the office, they're facing interest rates that are nearly twice as high or more. For most of May, our clients were seeing rates in the 5%. That's a lot compared to where we were, but it's about where rates were in 2018. While everything before the pandemic feels like a lifetime ago, it really wasn't. The Fed is raising interest rates to cool the economy and to prevent it from overheating. With most Bay Area counties seeing appreciation rates around 18%, a cooling down is probably a good thing. We're anticipating growth this year of about half of what we saw last year. In San Francisco last year, for example, we saw a 9% appreciation rate. We expect that to be closer to 4, maybe 5% growth this year. Finally, the stock market is officially in bear territory, which definitely spooks a lot of buyers and can sometimes paralyze folks into inaction. The stock market is a lousy metric of our overall economic health, but many of our buyers' down payment funds are tied up in company stock or RSUs. And as those values fluctuate, so do the buyer's ability to afford the large down payments that Bay Area real estate requires. This, combined with rising interest rates, creates a double whammy, which sellers should take note of. On the other hand, the imbalance of supply and demand has been so extreme lately, it was not uncommon to see offers of $1 or $2 million over asking for properties just last quarter. I suspect we'll see less and less of these extreme behaviors and more measured, well-reasoned offers. Again, this is not the end of the world and probably appropriate for a healthy market. I hope this analysis offers some helpful insight. If you're thinking of buying, there are still deals out there to be had. And if you're a seller, keep in mind that pricing has never been more important to get right, as the market is unforgiving of pricing mistakes. Either way, you don't have to navigate all this by yourself. We're happy to have a no-pressure strategy session with you to help you reach your real estate goals and level up your life. I'm Michael Minson, the Level Up Group. Give us a call. We're happy to help.